So for today's video, we're going to tackle about adjusting entries and we're going to focus on deferrals. So what is deferrals? Deferrals is the postponement of the recognition of an expense that already paid but not yet incurred, or a revenue already collected but not yet earned. So as we know, expense should be recognized once incurred, while revenue should be recognized once earned. Next, adjustments for deferrals. Prepaid expense. So prepaid expenses are expenses paid in advance. For example, supplies, rent, and insurance. It means even if it is not consumed and used, it is already paid by the entity. Normally, prepaid expense benefits for more than one accounting period. That is, there are expenses for future accounting period, and that is because there are expenses for future accounting period that are paid in advance. And prepaid expenses are assets and not expense. So at the end of accounting period, a portion or all of these prepayments may have expired. The portion of an asset that has expired becomes an expense. Prepaid expense can expire from time to time, and the expired or consumed portion of prepaid expense is recognized as expense. For example, in this example, the paid rent expense in advance is 24,000 pesos, and the rent period is 2 years. So it means if the period is 2 years, we can say that 2 accounting period will benefit in this prepaid expense or rent expense that was paid in advance. So this 24,000 is the example. So this 24,000 is the example of the prepaid expense, and it will fall on 2 accounting period, which is 2 years. Therefore, you can't use it as an expense for the current year because it is for 2 accounting period. That's why we will allocate this 24,000 in 2 years or 2 accounting period. So in computation, 24,000 is good for 2 years, so it is 12,000 per year that will be incurred, and the expired portion will be recognized as expense. If 12,000 per year divided by 12 months, it means the rent will be 1,000 per month. Next, adjustments for deferrals. Depreciation expense. When an entity acquires long-lived assets such as buildings, service vehicle, computers, or office furniture, it is basically prepaying for the usefulness of that asset. This means that those long-lived assets like buildings, service vehicles, computer, or office furniture, usually their estimated useful life is not only 1 year, like the building, it reaches 30 years. Service vehicle, 10 years. So these assets is useful for many accounting period and not only one. So it is basically prepaying for the usefulness of that asset. This means we will allocate the cost of that assets according to its useful life in different accounting period. So it is basically prepaying for the usefulness of that asset. This means we will allocate the cost of that asset according to its useful life in different accounting period. These assets help generate income for the entity. Therefore, a portion of the cost of the asset should be reported as expense in each accounting period. The estimated amount allocated to any one accounting period is called depreciation expense. So for example, the entity purchased computer equipment and normally it lasts for more than 1 year. It means this computer equipment can be used for the next accounting period. So let's assume that the useful life of computer equipment is 5 years. It means we can use this computer equipment for 5 years, which is worth 12,000 pesos. Since 5 years is the estimated useful life, It involves 5 accounting periods. We can't record it as 12,000 expense because it can be used for 5 years. So we will allocate the cost of the computer equipment for 5 years, meaning the cost that will be allocated each year is the account that we call depreciation expense. So depreciation expense is equal to 12,000 pesos, which is the cost of computer equipment, divided by 5 years, its useful life. Meaning we will recognize 2,400 depreciation expense per year, which is the allocated amount of expense for 5 years.